Hey guys, my name is Gareth and welcome back to my Finance Fitness YouTube channel where I break down personal finance, investments, real estate, stock markets and help people on the journey to financial freedom. So if that's something that interests you, make sure you subscribe to the channel. You can also click on the notification bell so you get an alert whenever I upload a new video. So I recently did a video where I looked at reasons why the stock market seems really expensive and seems why it could be due for a drop. And that's a good intro to the video today. So if you're interested, I've included a link in the description below. But there are two sides to a story, and I wanted to also explain why, on the other hand, the stock market may keep going up. And if it does keep going up, what this means for you and what you could potentially do in your investment portfolios to benefit from it. So stock markets are now officially at an all-time high. This is even after the massive 30% decline we saw in March 2020. In fact, if you invested at the bottom of the stock market dip earlier this year in an S&P 500 ETF or exchange traded fund, like the VOO from Vanguard, which really just tracks the top 500 companies in the US, then you would have made around a 60% return in just 6 months. For example, I made an investment in VOO and AOA ETFs in the second half of March 2020 and benefited from this rise in the stock markets in the past few months. My return on these investments have been around 52% in less than 6 months' time. I quite like these funds because they give you really good exposure and they're quite cost effective. And if you're interested in learning more about them, I've included a link in the description below. But there is this growing consensus between investors that the stock market seems really expensive, and yet it keeps going up and up and up. So here are 3 reasons as to why the stock market could potentially keep going up, and if this is true, how you could benefit from it. So stick with me to the end and I will share with you some ideas of what you can do to benefit from stock market increases. So as many of you may know, the US Federal Reserve, or the Fed, has stepped in with what is known as quantitative easing. And this is just where they fire up the printers and they start printing money. How much money? Well, in the past 6 months alone, the US Fed's balance sheet has increased by over $3 trillion, which is an amount we've never seen before. So what does this do to financial markets? Well, the Fed takes the money that they've printed and they go and buy financial instruments. Now in the past, this was really focused on high quality conservative bonds, but more recently they've expanded that and also been investing in more risky bonds of companies. So this type of intervention helps to stabilize the financial markets and provide some much needed liquidity and trading volumes. But many fear that the scale of the Fed intervention could lead to inflation down the road. Here, because there's so much money in circulation, the value of each unit of money could be less than it was before. But actually, I think there's something that some people are missing here, and that is that we're already seeing a form of inflation, and that's asset price inflation. Because asset prices have been going up across the board for stocks, bonds, cryptocurrencies, gold, even residential real estate. Everything just keeps going up. And one of the reasons could be the massive amount of money that's being pumped into the financial markets. So if the Fed is pushing so much money into financial markets, this naturally pushes up the prices of those instruments because of an increased demand, right? And what this means is that those investments become less attractive to other investors. And this is sometimes referred to as a crowding out effect. And this just means that many other investors are pushed out of that financial market because there's so much activity and competition and the returns are just not that attractive anymore. Ray Dalio recently did an interview where he was saying that bonds are not attractive anymore, and this crowding out effect combined with a low interest rate environment is some of the reasons why. Anyway, if investors look at the bond market right now and they see how prices have increased, they may look at other asset classes to try and generate some sort of return, and here they may turn to the stock market. And this increased demand for stocks may further push up prices in the stock market. We've also seen the US dollar come under quite a bit of pressure recently compared to other major currencies. So if you consider that the US stock market is up, but the US dollar is down, the net effect is that the US stock market is up less if you were to look at it from a euro or yen perspective, for example. If we see infection rates of this pandemic coming down more and more, or some positive developments on the vaccine front, this could be great news for many reasons. Economies can ease their lockdown regulations, and this can allow businesses to get back to work and producing and selling their goods and services. Staff can also get back to work and earning their monthly income, and all of this increased activity will stimulate economic growth. And stock markets will be quick to react to this type of news with positive expectations of future economic performance. And of course, most importantly, a vaccine will help improve the health of many people, potentially saving thousands and thousands of lives. And it will also take some pressure off the healthcare facilities and may open a window for people that need treatment for other things that have been put on hold. Stick with me to the end for a bonus reason as to why the stock markets may keep going up. And if you're enjoying this video, make sure you hit the like button. Companies can be incredibly dynamic, and we've seen many of them refinancing their debt during this low interest rate environment, that way reducing their interest cost. We'll also see many companies pivot or new companies starting up to create products and services for our new way of living and working. These new living patterns and habits create new needs, and companies will be quick to adjust and provide products and services to meet those needs. We'll also see many companies looking to cut costs and try and streamline their operations. Many of them may be looking at whether they need so much office space right now, especially when people are working from home much more, and this could be an opportunity for them to save millions and millions of dollars every year. And all of these changes can boost profits, and higher profits will be positive for the stock price of those companies. So I promised a bonus reason if you stick with me to the end, so here it is. Interest rates have come down significantly all over the world. The US is at near 0%, same with the UK, Europe, and even some countries are in negative interest rates. And what this means is that leaving money in the bank or in a saving account just doesn't generate much of a return. You're lucky if you're getting a 1% interest rate on a dollar saving account. And that is less than the US inflation target of 2%. So you're actually losing money. Never mind the potential taxes you'll have to pay on the little bit of interest income you actually do generate. So with interest rates so low right now, many people will be looking at other asset classes to try and generate some return. Real estate could be one option, especially residential real estate, because your interest on your monthly mortgage payments will be significantly lower. Another option could be stock markets, and this inflow of money into the stock markets would of course increase the demand for stocks and push up the prices further. So what do you think? Do you think the stock markets are going to keep going up, or is it time for a drop in the stock markets? Let me know in the comment section down below. Just remember that nobody knows if, when, and by how much the stock markets may drop in the future. There is no crystal ball, and nobody knows where the stock markets will be in 6 months' time from now. So here are some things that you can do if you think the stock market is going to keep going up, for some of the reasons we mentioned earlier in this video. For example, you may want to keep investing in the stock market, or at least not exit any positions you already have in the stock market. You could also consider investing in stock markets of other countries, especially countries with high growth rates like emerging markets. But if you're worried that the stock market may drop, which I think is slightly more likely, then you may want to keep some cash, potentially sell investments and lock in some profits, or you could look to diversify your portfolio by investing in things like gold, real estate, or maybe even cryptocurrencies. You could also take a more hands-off approach and just keep investing each month using the approach called dollar cost averaging. Here, you're not worried about timing the market and getting exactly right. Instead, you're just consistently investing every month and holding it for the longer term. Of course, it is best to speak to a financial advisor to see what makes most sense for your personal situation and investment goals. So that's it for the video today, guys. I hope you enjoyed it, and if you did, make sure you hit the like and subscribe buttons. I'll see you next time.